Stock markets in Asia have had a tumultuous ride over the past weeks, months, and more than a year of the COVID-19 pandemic. The ongoing spread of the Delta variant, nervousness around US interest rates, and geopolitical factors have caused markets in the region to fluctuate. What's more, the global outbreak of the coronavirus has created a unique situation in the financial landscape. As steady income declines, first-time investors have been jumping into equity markets, snapping up initial public offerings in particular, raising questions about long-term stability. We make sense of these new trends with Rahul Chadha, Chief Investment Officer at Mirae Asset Global Investments. A very warm welcome to you, Mr. Chadha. Thank you for joining us today.
Thank you for having me.
And well, we've seen the South Korean stock market go up and down over the past few weeks. And well, it did South Korea's main bourse, it did start the week with a rebound, but it's taken quite a battering over the past few weeks. What's caused the recent downward trend in the Kospi and spot this massive foreign investor sell-off that we've seen, especially among the tech stocks?
Okay. So what we're seeing across the region is this rise of Delta variant, which is weighing on sentiment. Cases are picked up across the region. I think if we talk about recent weeks, it's the fear of the Fed taper, which is playing on minds of investors. If we look at markets, last 18 months, most markets across the world have had a good run. So some bit of a profit booking is natural. So from our side, this is a correction in a bull market. We'd not be too much worried about this.
Right, well, other Asian markets have also taken quite a tumble in recent days, in addition to the Kospi. And this year, actually, South Korea, Taiwan, India and Japan, they've all experienced this massive outflow of foreign investments. Why are these countries particularly sensitive?
Okay, so I think what's happened is these countries received a lot of inflows last year. A lot of this was macro money which came because Fed was pursuing easy monetary policy. Now, as Fed looks to tighten or withdraw some of these stimuluses, etc., some bit of an outflows are happening in the market. But eventually, what drives stocks is earnings. And our view is that, look, earnings momentum should be on a strong trajectory, and that should get investors back into these markets.
Right, well, emerging markets in particular, they've been a bit worried that there's going to be another round of the taper tantrum seen in 2013, and they're keeping very close eyes on the US Fed and what they'll do with their rate hike. And they're worried that tapering really would trigger an outflow of capital as investors chase yield elsewhere, and a sell-off of currency as well as a surge in borrowing costs. What's your view on all of this? And do you think Asian central banks are better prepared than they were a decade ago?
Okay. So what this tapering would cause is some bit of a rise in US 10-year yields. If we see from December 19, Fed and some of these money market funds are buying close to 70-75% of the issuance. So it's but natural when Fed tapers, the bond yields move up. And because of bond yields moving up, some of the expensive growth names may correct. But look, this situation is not as bad as 2013. When we were in 2013, most of the EMs were running high current account deficits. They were running high fiscal deficits. The previous 5-7 years had seen misallocation of capital in the economy. None of those things have happened in EMs this time around. The last 6 to 7 years have not been much growth in EMs. So you've not seen all this irrational exuberance in EMs. And that's where our basic view is that this is not going to be like 2013. Obviously, there is going to be some pullback in market, but we would look to add our EM exposure post that pullback.
Right, and what are your prospects on supply chains around the world, as well as the economic rebound in the US? How is that going to affect Asian markets in the months to come?
So I think the economic rebound in the US is kind of proceeding exceedingly well. What we've seen is little softening of data in recent weeks, but that's but natural as the consumer is holding back post a sharp run in product prices. But if you look at overall housing data, you look at consumer data, ISMs, etc., I think that's a decent rebound which is underway. What we often miss is the huge amount of savings which are lying with the US consumer. So as the economy opens up with the Delta variant receding, I think the consumer is going to go out and spend that money. So we believe that this growth story kind of lasts for another 2 years at least, and that's why we're positive. If you look at the US capex intentions, those are also picking up. And with that as a strong backdrop, I think EM should do well.
And well, over the course of the pandemic, South Korea's main bourse, Kospi, was continuing to surge with an influx of retail investors, and they've really been snapping up those investment options and IPOs. And well, many say that this has been generated by borrowed money on low interest rates and relief funds. What do you make of this huge influx of retail investors who are massively investing into IPOs and equities?
So I think this is a trend, or this is a phenomena seen not only in South Korea, but in India, in China, in Taiwan, everywhere. Even in the US, if you see the retail margin balances are a record high. Look, from a retail investor perspective, bank deposits don't give them much, which is why it's but natural to come to an equity when economy is on an upturn. So if you ask me, the risk for the markets is that, look, should the Delta variant continue longer than expected? Should the Fed taper be a lot more severe? Some of these retail financing or retail margins may unwind. So that, if you ask me, is a key risk for the market. That across the region, retail's levered up and is invested in the market.
And well, how stable do you think the Korean market is right now? Do you think it's maybe gotten ahead of itself? I mean, which sectors do you think might see a correction?
Okay. So there are pockets in the Korean market which are a bit expensive. So if one has a 2-year time frame, obviously nothing to worry. If the time frame is 3-6 months, some of these growth names which have gone up 3 to 4 times may correct a little bit over the next 3-6 months. But from a 2-year, I think these are good companies. These internet companies are good companies. They've got a strong growth tailwind behind them, and that should be okay. Overall, if we see from the highs, the market's corrected by anywhere around 7 to 10% if we look at the bellwether names. So the market looks reasonable now, but the fears of tapering can cause some more correction. But like the way I said, we will use the dips to add to our exposure.
And as you mentioned before, the Delta variant continues to surge around the world, and there's also some uncertainty around tapering. Then how do you expect the Kospi to finish this year? Which sectors do you think will be able to be resilient throughout the uncertainty?
Okay. So I think some of these secular structural growth stories, like the internet, may hold on from here. We've seen the financials correct a bit, but the valuations are attractive over here. Even with the tech sector, the semiconductors, there's been a correction in recent weeks on these fears of excessive inventories with the smartphone server makers. I think now the sectors, from a medium-term perspective, are attractively valued. So overall, I'm optimistic that, look, sitting here to the end of the year, we should end with a positive return.
Right. Well, do you see the interest in these mid-cap stocks continuing and really changing the investment landscape, not just in Korea, but across global markets as well?
So I think the mid-cap trend is very similar to the retail trend we were talking about. Across the world, mid-caps, small caps have done well. But typically, these mid-caps do well in the first half of the recovery. First half of the recovery is easy liquidity time. It kind of lifts all boat. It's only in the second half when liquidity gets tightened that some of these mid-caps or small caps, which are pie-in-the-sky stories where earnings are not fully backing the valuations or the growth promise of these names, get impacted. So we believe that fundamentally sound mid-caps would do well, but mid-caps which are expensive or where the earnings follow-through doesn't happen, those may be under pressure because liquidity may be a bit tight going into 2022.
And well, when you look at all this retail investment that's just flooding in, do you think it will bring more instability to markets?
See, I think retail investment always causes a bit of a volatility to the market. But look, as long-term institutional investors, what we focus on is the underlying earnings, and I think that is what is in our control. So that's where we get the comfort that, look, if we see what is happening in the world, a beginning of a capex cycle, if we see what's happening in terms of consumer spend, they've softened a bit, but look, the savings with consumers are fairly high. And should the variant recede, the consumer should go out and spend. That should be positive from a stock earnings perspective. So I think that should take care of the near-term volatility which may come because of retail investments.
And would you say that these new IPOs, they are giving some businesses opportunities to really gain the capital that they need?
Absolutely. I think what these new IPOs do is, and we've seen some in Korea, we've seen more in India and China coming through. they create huge amount of excitement. They create huge amount of tailwind for that specific sector and generate new employment opportunities, give a whole lot of encouragement to upcoming companies in that sector. So it keeps the investment climate a lot more vibrant and keeps the corporates on their toes. So it's always good for markets, new paper coming. So.
Right, and now the US-China rivalry that's been just disturbing markets for months and months. How has that influenced investment trends in the past year? And will the recent regulatory barriers in China drive investment elsewhere?
Okay, so I think what's happened is these recent kind of regulatory barriers over zeal or has impacted the investment climate. Look, these internet platforms were where most investors were invested in. So obviously people are sitting back and trying to make sense of what's happening there. But a broad view still remains that, look, China encourages, welcomes private sector investment. What happened in the education sector was just one-off, but overall they want to bridge the income gap in the society. At the same time, they want their private sector to thrive, be at the forefront of innovation. So that's positive. From a US-China rivalry, what it does is it creates new opportunities. It creates new opportunities in sectors China is keen to promote. These would be indigenous software. These would be indigenous semiconductors, high-tech sectors. And more importantly, China looking to promote this dual circulation, which is promoting domestic consumption, obviously creates new investment opportunities for funds like us.
And well, without a shadow of doubt, ESG has been quite the buzzword in Korea, and well, but then there are still doubts. There are questions as to how transparent it is, whether it's performing well. Does the growth and performance of ESG investments look promising to you?
Absolutely. Again, at Mirae Asset Hong Kong, we're at the forefront of the ESG initiatives the group is taking. So this kind of starts with a strong stewardship code, a voting policy we put in place, the engagement with the companies and all that stuff we are doing. So I think this is clearly a very positive trend which is happening across the region. And what it does is it makes corporates kind of accountable to all the stakeholders. These are internal and external stakeholders. And I think what it also does is, particularly for Korea, it leads to re-rating of these names. So what we've seen is traditionally, historically, some of these Korean companies have traded at discount to the Taiwanese peers, where business fundamentals are very similar. I think with corporate Korea embracing ESG, some of this discount to regional peers can easily narrow.
And do you also see opportunities for South Korean investors or companies to get engaged in ESG projects in Asian markets, and particularly in South Asia?
So there are two sets of projects which are coming. One is fixed income financing, where I'm sure there's going to be a lot of interest from South Korean investors. May start with the sovereign fund looking to spearhead investments in these clean energy initiatives. And then there are thematic funds. I mean, our company, Mirae Asset, has launched a lot of thematic funds, which are ESG funds. Within our active funds also, we've got a fair bit devoted to the positive impact companies. These would be the companies which are using ESG to improve their governance, to make a positive impact on the society. And plus, there is exposure to these renewable sectors, sectors which help in reducing the carbon footprint for the world.
And just before we go, just to wrap up, there's quite a lot of uncertainty ahead, and we don't know when this Delta virus is going to start declining. So in the months to come, what would your advice be to investors, particularly first-time investors?
I think a sincere advice would be, look, we're still constructive on markets. We would be buyer on dips, but I would not recommend them to use leverage, because look, the easy money in market is behind us. So I think what using leverage does is it just makes you a bit more impatient. Invariably, one would sell at the wrong time. So this is not the market for the faint-hearted. Market is going to be choppy from here. So if you have holding power, you will make money in markets. But if you're impatient, you may exit at the wrong time. So don't use leverage.
Very solid advice from Rahul Chadha, Chief Investment Officer at Mirae Asset Global Investments. Thank you so much for your time today.
Thanks for having me.
And to our viewers, as always, thank you very much for watching.